Good morning and welcome to Bazaar Morning Call. I am Anuj from our New Delhi studios, and of course, joining me from the Mumbai studio, we have Sonia and Prashant as always. Sonia, Prashant, good morning. You know, what a strong day we had yesterday for the market, not just in terms of the price action, but the vote of confidence that is there in the Indian market once again. The dip getting bought and how, especially in the bank nifty, and the decoupling theory is now getting stronger by the day. We all have the numbers now and how Indian market has really been the best performing market on all time frames. And the bank nifty, well, what can you say about that? What a leadership from that index. Weekly options expiry today. The momentum is firmly with the bulls. The STX Nifty is indicating that we'll once again reclaim that 18,000 mark and actually trade above that. Let's see how things move. Sonia, Prashant, hi, good morning.
Hi.
Good morning, guys.
Morning, Anuj. Morning, Prashant. Absolutely. I mean, this market, right, the Indian market is bulletproof. I mean, there's no other way to put it. Just look at what's happening across the globe in our own markets. Every dip is getting bought. And as you said, the star of the show yesterday undoubtedly was the Bank Nifty, Anuj. 1,100-point intraday recovery is what we saw in the Bank Nifty. There was quite a bit of delivery-based buying that we saw in a lot of the larger banks. In fact, it was not just banks. It was the domestic consumption piece. There was FMCG. There was cement stocks, which saw big buying interest as well. So we'll keep an eye out on that. Global markets didn't do much. There was barely a 30-point move that we saw on the Dow. There's a raft of economic data that comes out later today, so all eyes will be on that. Retail sales, import prices, jobless claims, and these are the last few data points that we get before the Fed policy. Of course, the Fed may have already taken into consideration the data and decided what it plans to do. The base case expectation still remains a 75 basis points rate hike. For our own markets, though, after many days of buying by FIIs, we saw a sell-off yesterday, almost 1,400 crores of selling. DIIs bought a tad bit, about 200 crores. But, you know, this market is so insulated from all the global challenges that Anuj, one wonders whether, despite everything, whatever the outcome of the Fed, will this market continue to chug along? That's the big question now, because not just the headline index, which has been resilient, but there's so much buying in themes, right? Whether it's consumer durables, home improvement, real estate, defense. These themes are really delivering big gains.
You know, Sonia, we'll remember we were discussing this in Editors Roundtable. The point I keep making, don't watch SGX Nifty or the Dow in the evening. You know, because the Dow is getting impacted by its own news, like Tuesday evening, and you saw what the market did yesterday. And the kind of money which has been chasing stocks, the banking, consumption, autos, and I think these are the themes which continue to do well. The only risk in this market is to stay out or book too soon. Yes, the market will give you days like yesterday when it will make you sort of challenge your thesis about whether the bull market is intact or not. But let the market throw you out. I think the market would not have thrown you out if you had kept logical stop loss. You need to keep trailing your stop loss, of course, in a rising market. On Nifty, that level is very sacrosanct now. The 20-day exponential moving average, even yesterday, the market almost tested that, and from there, bounced back. That level is somewhere around 17,650 to 17,700 now. So as long as that's holding, every dip, small or big, has to be lapped up with both hands. And really, in a bull market like we have, yesterday's dip was that full toss that should have been dispatched. Now, on the Bank Nifty, the problem is that while yesterday was a good risk reward, now you are in a parabola. And I don't know how you enter that, because if you want to chase it on weekly options expiry day, as a day trader, sometimes it can be risky. The best entry zone is between the 5 and 10-day exponential moving average, which is somewhere around 40,260 to 40,730. The market was charitable to give you that dip yesterday. I don't know if there'll be another dip, but normally in markets there are. So, you maybe want to wait for that if you haven't been already in the Bank Nifty, that is. Now, what is very interesting is the FI data in the futures and options market, where FIs are still short. In fact, yesterday they added another 20,000 shorts, and now their short exposure is at about 74%. So again, this is a market where there's a bit of a disbelief, there's denial, but the market keeps moving on. Now, this rally also explains that this has been a rally which is a bet on the Indian economy. It's got nothing to do with what the dollar index is doing, what the Fed might do. The Fed might raise rates by 100 basis points, and our market will move on. Because the bet has been taken on the economy-facing stocks. The Bank Nifty is leading it. All other domestic sectors like autos, consumption, FMCG, they are doing well. And once again, you saw IT, for example, after the two-day rally, once again retreated. So the IT rallies would be bear market rallies, which might be an exit opportunity. But for the rest of the domestic economy sectors, every dip, small or big, is a buying opportunity. Prashant, hi, morning. What do you have for us?
Anuj, the objectives we run out of, right? I mean, resilience and outperformance and all. But I'll tell you this, if you're trading, there is an old saying, right? It's never as bad as it seems, but it's also never as good as it looks. I mean, on both sides, people tend to overdo things. When the market's correcting, well, there is no tomorrow and it's going to go down even more. When the market's going up, it'll just keep heading higher and higher. It's just what momentum does to people, to our brains. You can't sort of seem to look otherwise, right? I mean, when you're in a strong uptrend or a downtrend, the impulse is to believe that this will continue and there will be no end in sight. So with that caveat, with that one-liner, let me just quickly put out a couple of points. So the outperformance, of course, is there for all to see on all time frames. I mean, on a day-on-day time frame. The S&P was down 4.3% on Tuesday. Yesterday, the market here lost just about 1/3%. I don't remember the last time we saw this kind of, big difference. Year to date, I'm talking about time frames. Look at the performance. The S&P is down 18%. The Nifty is up almost 4% or so. So this is quite incredible. Now, what is going well for us is the fact that commentary from corporates is seeming very, very optimistic. And that does bode well for domestic earnings growth. A lot of domestic-facing sectors can benefit if domestic demand is strong, as the commentary indicates. At the same time, I remember this, I think Credit Suisse a couple of years back put out a report, about 50% of earnings, Nifty earnings, are global in nature, right? So if the globe does slow down quite a bit, I think, you got to basically expect no help from global markets and, global macros in that sense. And that is, you can't brush that aside completely. You've got to stay cognizant of that. You've got to be aware of that as well. Financial conditions will continue to tighten globally, as we've seen after the CPI. I mean, they've tightened incredibly powerfully after the Jackson Hole speech and, of course, after US inflation as well. And that's the fountainhead for money globally, right? Dollars globally, the US Fed. And they're going to tighten. So I think that is, so basically local commentary and expectations and hopes are high, but the global picture is going to stay troubled for obvious reasons, as we've been highlighting. As a consequence of all of this, if the inflows continue and consequently if the rally continues, it will have to be a very India-specific one. I mean, it's not a broad global risk on. It will be very deliberate India-specific moves that we will see if we are to see a continuation of these big moves that we are seeing at this point in time. I mean, time frames matter if you're trading, if you're investing. But I think for both, one thing is very clear, starting points matter. So in that sense, a risk reward, Anuj, as you also highlighted, I think becomes very, very important, especially if you're trading. I mean, if you've got time on your side and you're long term, I mean, you can kind of weather some of these blows and drawdowns, which are natural, which are par for the course when you are investing. But if you're trading, especially if you're on the futures and option side, etc., entry points matter. I mean, I think that becomes the primary, at least the primary thing to start with as you do all of that. So I think that's my short piece. But as I said, I would sort of wrap up this piece with one more thing, that there are, as they say, there are old traders and there are bold traders, but there are very few old and bold traders. I mean, it's just percentages. So keep that in mind. If you're trading, especially if you're investing, if you've got time on your side, it becomes a little more easier. Not very easy, but a little more easier. Sonia.
We had this very interesting discussion with Simon Powell yesterday, and he was talking about how the Gen Z, right, the new generation, is now getting big into not just investing, but even into consumption, etc. And India has the largest population of Gen Z in the world. So the kind of money that's also coming in from the younger generation has picked up dramatically, especially post the pandemic when people have opened their demat accounts. And in the markets, we're seeing this, at least this month, we've seen a big pickup in consumption stocks, domestic consumption names. So whether it's Shree Cement, whether it's Bajaj Finserv, ITC, Tata Consumer, SBI. These are all domestic-focused companies that are catering to this whole consumption theme. All right, let's do one thing. Let's kickstart the show. The SGX Nifty is bright and chirpy this morning, indicating a 50-point bump up. Here's our first comment for the day. We have a view coming in from Vikas Jain of CLSA, who says that the last 3 months have seen a cool-off in oil prices and yields, which has fueled a strong 20% rally. But this benign macro setup may change, as big global events over the next 3 months could force investors to take a fresh stance on important macro debates like a US recession, inflation, geopolitics, China's COVID lockdowns, commodity prices and Indian consumption demand. With Indian equity valuations in the top 10 percentile on absolute and relative basis, they are uncomfortable about equity returns going into these big macro events.
All right, Gautam Dugat of Motilal Oswal says that India's earnings cycle has seen a turnaround after almost a decade and continues to remain healthy amid the current adverse macroeconomic scenario, with heightened worries about rising rates, elevated oil prices and liquidity tightening that has kept the market volatile and jittery. They estimate FY 22 to 24 profit after tax CAGR of 17%, led by banking, financial services and automobiles.
Okay, let's also try and get you some money market views for the day, because there's plenty happening in that world. On the rupee itself, we have Parul Mithal Sinha of Standard Chartered Bank, who says that the rupee has continued to outperform EM forex markets despite persistent dollar strength post Jackson Hole and the US CPI data. The US dollar sales by PSU banks, FPI inflows and oil prices at sub-95 levels have supported the rupee. Expect to see the dollar INR trade in the 79.25 to 79.75 range this week.
Well, in the bonds, we've got Parul Mithal Sinha, who says that rates market has been relatively well supported vis-a-vis global rates and sustained hopes around index inclusion. The INR yield curve has flattened sharply in line with global trends. They expect the 10-year yield to trade in the 7.08 to 7.18% range next week, with developed market central banks front-loading large rate hikes. Market expectation for the upcoming September policy has moved to 50 basis points.
Okay, there are plenty of stock-specific, trades today or action today. Actually, we'll get to that in a bit in our special top 10 segment. We're looking at Balaji Amines, KPI, Green Energy, there's KC International, there's Home First Finance, Aditya Birla Capital, ONGC and Oil India. These are stocks on our radar on the back of positive news flow. And then on the negative side, there's PVR, Sundaram Fasteners and GR Infra projects that are likely to open in the red. But let's also get you some opinion now, with the US seeing inflation coming in higher than expected in August and the Fed meeting now scheduled for next week. All eyes will be on what the Fed does and what the reaction will be of risky assets like equities. Here's Mark Mobius of Mobius Capital Partners and Ethan Harris of Bank of America Securities with their view on how the Fed should move.
If they go up 1 or 2% at each meeting, then they can get there pretty quickly. And it seems to me that if they really want to do something and have some effect, they've got to have much bigger jumps in their inflation target rate. I think the game plan is if you want to beat inflation, you've got to raise interest rates. And they're not looking at the stock market, or they shouldn't be looking at the stock market if they're working according to their rules and regulations in their central bank. They should be saying, look, we've got to have stability. In order to do that, we've got to raise interest rates. And that means do it quickly. In other words, try to hit it as quickly as possible. Otherwise, it can get worse.
And it's really not the speed of hikes in the short run. That's kind of, they're catching up now. This isn't a hawkish Fed. They're just catching up. They started 6 months late, and now they got to go really fast. The real question is, how far do they go? When do they stop? And how long do they keep rates at very high levels? And that we'll only learn gradually over time. They themselves don't know where they're heading here. But I think a reasonable forecast has to have the funds rate going at least above 4% and conceivably as high as 5% in order to get that recession they need, unfortunately, to get inflation under control.
Well, Matt Orton is Chief Market Strategist at Carillon Tower Advisors. He's joining us right now. Matt, great to have you back on the program. Thank you very much. You've been positive, emerging markets, especially markets in Latin America, India, China, and you remain constructive. But just to, let's start this conversation with a quick view on what the inflation number out of the US means, and does that change your views in any way in terms of the Fed's reaction function and in turn what the market will do, stock markets will do around the world? Your sense?
Yeah, good morning. It's great to be back. And I think the data that we got earlier this week on Tuesday was there's no way around it. It's uncomfortably high inflation data. It doesn't, I don't think, change the long-term outlook I have on markets. Overall, I think that the Fed's 75 basis points is what's going to be on the table. Certainly 100 basis points is now possible, but I don't think that's what the Fed's going to do because at the end of the day, we're even moving 75 basis points is still going to put the Federal Reserve at 75 basis points above the long-term neutral rate. So it's already going to be well into restrictive territory. But the lows that we had in June already impound a lot of this worst news situation. So I don't think we need to necessarily go down to the June lows or below the June lows. I think the market is already impounding a ton of really, really negative information. It's fashionable to be bearish is what I'm telling a lot of clients. There's some rooms I'll be in where I'm the only person who might not be a bear on the equity market at this point. Positioning is incredibly bearish as well. Hedge fund positioning in global equities is near multi-decade lows. So from a positioning standpoint, the fact that we haven't breached key technical levels back going down to the June lows, I think that is a little bit more constructive. I think emerging markets as well, going back to your question, Prashant, they have been holding up very, very well relative to the US and relative to global equity markets. And in particular, Latin America and India have done well. And I think it's because Latin America was ahead of the curve with respect to a tightening cycle. So their central banks are almost done tightening rates, if not already done tightening rates. And the economies have held up fairly well. Having some commodity exposure, I think, has helped them. You're seeing strength in industrials and materials in a lot of those economies. Those are parts of the market that I think will hold up well in a slower growth environment, an inflationary environment. So that's what's working. And India in particular is a little bit more insulated, like you were talking about earlier, from some of the global malaise that we're starting to see. The markets are looking for idiosyncratic stories right now, and both of those fit. So when I talk to clients, I tell them to continue to keep a core defensive bias in portfolios. But when the market provides us with opportunity, when you have moves like we did on Tuesday, particularly in the US, use it opportunistically as a long-term investor to pick your positions. Small caps, I think, look attractive from an earnings perspective and a valuation perspective. Emerging markets, Latin America and India in particular, also look attractive to add for global asset allocation. So that view does not change.
Okay, that view does not change. Matt, hi, good morning. And that view has played out in India, right? Especially the domestic stocks in India have done remarkably well. They are in a bull market of their own. The Indian consumption stocks, the automobile stocks. To your mind, you think this is start of a fresh bull market in India, where even when the foreigners didn't buy a lot, the domestic sort of inflows kept the market intact, and now we have seen a return of foreigners as well. So could India be in a bit of a Goldilocks scenario?
India is certainly benefiting from a relatively strong economy at home, and also the fact that there really is not a great place to put your money elsewhere in the world. It's a little bit harder, especially as a local Indian investor, to be looking to the US and saying this is a great place to be relative to what you have at home. So I think that is benefiting the market as well. And earnings have held up. Yes, valuations are expensive, but that in and of itself is not a reason not to own something. It might be a reason to be a little bit reticent to be adding to exposure at these levels. But again, that's why I say we use downside opportunistically. Is if you do get a sell-off in Indian markets, like we've seen around the rest of the world, that's probably an opportunity to put a little bit more money to work, because the longer-term fundamental trends, both from a macro perspective and company-specific perspective, are holding up very well.
But it's already been a 15% rally that the Indian markets have seen in the last 3 months, right? That's quite a ferocious move on the upside. Do you think the risk reward is still favorable for an Indian investor to pump fresh money now for the near to medium term?
It's not as favorable as it was in a month or 2 months ago. Absolutely not. But On a relative basis, I still think it is. Again, I don't advocate for chasing the markets higher. I think you've got to let the markets come to you. So looking at where we are now, looking at the fact that there's been such a relative gap, especially after the negative CPI news, I think that's a point to wait until you see a little bit of downside in the market. And as a long-term investor, it's still a good time to be putting money to work because there's still a lot of opportunities. I mean, when you look at the emerging market complex as a whole, you've had a decade plus of pretty terrible underperformance relative to the rest of the world, relative to international developed equities, and particularly relative to U.S. equities. So this trend can continue, and especially when you have stronger underlying fundamentals that likely aren't going to be challenged by the Fed rate hiking cycle in the U.S. and backed by a consumer that's willing and able to spend at home, I think that lines up very, very well to use downside to your advantage.
So, you know, tech as a space, Matt, how do you feel about that? You know, IT services here, we don't have tech product companies, at least not very large ones like you got in the US, but essentially that is a space. What are your views?
So I think tech overall has tremendous long-term secular growth trends. I mean, sure, some of the large FANG and mega cap tech names in the US might not exist in India, but from a long-term investment perspective, I think technology, at least so far this year, has lagged to the financials complex or industrials, materials, energy. So I think there can be opportunities in information technology. And when you think about what companies are investing in, information security, that is a key investment that companies are going to be making. So having exposure to anything on the cyber side of the business makes a lot of sense. When you talk to chief technology officers at global institutions, the one area where they are not cutting spending going forward is in information technology and security. So that trend is going to continue. And we're also starting to near a point in the cycle where companies are having to reinvest in their cloud computing, offsite software services. So that's why you're seeing enterprise, at least you're seeing it so far in the US and some other global companies, hold up very well. So having exposure to enterprise software, cloud computing is another longer term trend that I think looks really, really attractive long term.
Okay. All right. Just a two-part question before we let you go. What are your top markets now to invest into from a 12 to 18-month perspective, one? And two, you know, despite whatever comes out of the Fed, whether it's a 75 basis points rate hike or a 100 basis points rate hike, would that change your market view in any way?
I don't think the size of the hike is going to change my view. If we get a 100 basis point hike with guidance that the terminal rate's going to continue to drift higher, I think that makes me more marginally bearish on U.S. equities. I do. I think that starts to force investors to compress valuations, but that's not my base case. If we get a 75 basis point hike, I'm still optimistic on U.S. equities. Valuations are fairly cheap, especially when you consider in the U.S. How much the world has changed from long-term averages. The U.S. economy has transitioned where information technology and some higher duration pockets of the market make up a much larger percentage of our indices. So comparing valuations today to 10, 20 years ago isn't fully appropriate. I think you've got to adjust for the size of changes in companies and how the economies have changed. So I still think at these levels, and especially if we move lower, U.S. equities do continue to look interesting because profit margins are holding up and earnings have been holding up. The earnings apocalypse hasn't materialized, and I don't think it's going to. Guidance has been adjusted down, and I think it's been adjusted down pretty fairly. So I do like the U.S., but in particular on downside, I really do like adding to emerging markets because from a long-term perspective, you've had such persistent underperformance. And again, the areas to be, we've talked about this a few times in a row, it's still Latin America and India for those long-term, more positive fundamental trends, insulation from some of the other global challenges. And I also don't like throwing China out either because China's very, very cheap. And as they emerge from some of the COVID lockdowns as a long-term investor, having exposure to some industrials and energy companies in China, I also think makes a lot of sense for a long-term investor.
Okay, we will leave it at that. Thanks a lot, Matt, for joining us. India is well placed from a macro and a company perspective. That's always good to hear. And India has, by and large, been bulletproof in these global challenges. Let's slip into a quick break. Our entire team will be joining us to help us with the list of top 10 stocks in just minutes from now. Stay tuned. So the SGX Nifty this morning is indicating that the start will be well in the green, up about 45 odd points. Our entire team is joining in to help us with the list of top 10 stocks for the day. Anuj, let me begin with you. What's on your radar today?
Well, not from the just today's point of view, Sonia, but just want to reiterate the importance of leadership. The two stocks where we have seen the highest amount of delivery buying over the last 2 months or so, SBI and ICICI Bank. And these are really your two go-to stocks if the market has to rally intraday, and every time the market's declining. And these are the stocks where you see first sense of buying. And this is so reminiscent of what was happening in, even that 2003 to 6 phase. A bit of a parabola now for both these names, but the leadership is way too strong in both these names. So I'll keep an eye on both of these names in today's trade as well. As I said, maybe not just purely from day trade point of view, but from leadership point of view. But let's go across to Nimesh then. He's watching out for a couple of stocks where there's going to be block deals. Nimesh?
Yes, Anuj. So I'll start with PVR first. There is a large block deal, 7.7% equity is what is likely to change hands. So a clutch of private equity investors are going to sell stake, including Multiples Private Equity, which is run by Renuka Ramnath. Now, the indicative price is between 1852 and 1929, which indicates up to 4% discount to yesterday's closing price. So execution will be key. But if you look at the shareholding pattern, it's a highly institutional-owned stock. 83% is between mutual funds, FIIs, and private equity. So likely it's going to be a change of hands from private equity to FIIs and domestic funds. So as I said, execution will be key, but given there is a 4% discount to start with, the stock could be in the red. So that's the first one. The second stock is Sundaram Fasteners. It was part of my charter list while I was, the indication was that a FII was a seller, but it turned out to be the promoter entity, TBS, Sundaram. They have sold 1.2% stake, which is close to 25 lakh shares in a block deal yesterday. And 2/3 of the block was bought by ICICI Pru Mutual Fund. So good investor has bought, but the fact that the promoter entity has sold, maybe it will start in the red as well. The fact that the promoter have sold nearly 1.2% stake in block deal yesterday.
All right, Nimesh, thanks very much for that. So we'll keep an eye out on both those names as we start today. Now, some news from the infrastructure space. GR Infra, there is a offer for sale today, and there is KEC, which held a investor meet as well. Vivek is standing by with details on both those. Vivek, hi, morning.
Well, good morning. Well, the first one, of course, as you mentioned, is GR Infra. Now, the promoters currently own a stake of almost 86.5%. So in order to adhere to the shareholding norms, they have forced to sell stake. So the route that they've chosen is via the OFS route. So the company, the management actually has announced an OFS where they're looking to pair almost 6.8% stake in the company. A base size of this particular OFS is almost 5.9%. And the floor price for this particular OFS is set at 1,260 rupees a share, which is a significant discount of a little over 8% to yesterday's closing price. It's going to be interesting to see the demand for this particular OFS. The other stock that you mentioned, KEC International, yesterday the company had met analysts at the RPG annual investor conference. Q1 FY23 for KEC was a little underwhelming. So a couple of analyst concerns were addressed, especially in terms of high debt as well as margin concerns, especially given the SAE project as far as Brazil was concerned. The company actually assuaged investor concerns on both of those fronts. In fact, they said that FY23 YTD order inflows currently is at 6,000 crore, and they've almost reached 30% of the FY23 guidance that they had given. They've targeted an order book of almost 20,000 crore for FY23, the order inflow. The order book target for FY23 is almost 40,000 crore, and this is something that the management said that they will also be bringing down the net working capital days down to 125 to 130 days by Q4 FY23. Nomura has given a buy target on the stock with a target price of almost 556 rupees a share.
Okay, and in that Nomura note, they also say that the debt levels for the company has risen sharply in FY22, but could witness some reversal by the end of FY23. So keep that in mind as well. Sonal is here with us to talk about Balaji Amines and KPI Green. Sonal, over to you.
Good morning, Sonia. Starting with Balaji Amines, because finally they have been able to complete phase 1 of Unit 4, where they were going to produce DMC. Now remember, this was supposed to be completed in Q1, so there is a slight delay there. But the commissioning of this particular project is definitely a big positive. Not only that, the company has gone ahead and announced capex to add capacity in phase 2 of Unit 4. And they say the total capex here will be around 200 to 220 crore rupees, and it is going to be funded via internal accruals. KPI Green, that is the other stock in focus, because it has received new order for executing wind-solar hybrid power project of 4.2 megawatt under captive power producer segment of the company. It is a third-party solar power provider, and particularly in their captive power producer segment, they develop, transfer, maintain grid-connected solar power projects for its industrial customers. So these two stocks will be in focus today.
Okay, Sonal, thanks a lot for that. Let's go across to Abhishek then. He's watching out for a couple of mid-cap NBFCs. Abhishek?
Well, Anuj, as you mentioned, Home First Finance is on radar. There are news report from Business Line which says that Warburg is looking to exit Home First Finance. Now, remember that, Warburg has a stake of about 28.73% in the company, and they are in talks with various NBFCs as well as banks. So, Warburg has reached out to IndusInd Bank, Shriram Housing, RBL Bank, Yes Bank, and Vastu Housing Finance. So, the valuation that has been sought by Warburg, as per the news report, is about price to book value of 6x, while the stock is trading at 4x. So CNBC-TV18 has not verified this news report independently. However, just to alert our viewers, Warburg had entered into Home First Finance in September 2020. Another stock on radar is AB Capital, wherein Abu Dhabi Investment Authority has got a nod from CCI. The nod is for buying up to 10% stake, that is 9.99%, for a consideration of rupees 665 crore in Aditya Birla Health Insurance. So Aditya Birla Health Insurance, this transaction is also subjected to various other regulatory approvals like ADI, etc. Back to you.
Okay, thanks a lot for that. Well, crude is in focus because we are heading into the US Fed meeting, and crude has been hovering around $93, $94 a barrel. Manisha is here to tell us more about that. Manisha, good morning.
Morning, Sonia. Thank you for that. Well, we have seen the crude oil prices surge even higher in the last 24 hours. We are trading at a one-week highs right now, and we've done $95 a barrel for the Brent prices there. This is after the IEA report, which says that they're looking at a strong demand for crude oil in 2023. The OPEC says that they're looking at a higher demand in 2022 as well as 23. So the strong demand scenario is supportive. And then there's a large-scale gas to oil switching in many countries because of the gas supplies not reaching enough. And then the markets also are looking at the likelihood of a U.S. rail stoppage due to an ongoing labor dispute. Support also comes in from the fact that the dollar index has seen a pause or a decline from the recent highs. So almost everything seems to be supportive. And not just crude, the U.S. natural gas prices gained 9% overnight. The European Union gas prices were up 8% overnight. This is after the European Union drops the plan to impose price cap on Russian imports. So there are many headlines coming in for crude, and almost all of them supportive of price.
Sonia, Manisha, thank you very much for that. Appreciate it. That's oil and commodities very much in focus. Here is a quick recap of the top stocks that we're watching out for. Stocks with positive news flow are Balaji Amines, KPI Green Energy, KC International, Home First Finance, Aditya Birla Capital, ONGC, and Oil India. Well, stocks with negative news flow are PVR, Sundaram Fasteners, GR Infra Projects, and a few more. We'll take a very quick break here. Up next, Rajesh Bhatia of ITI Long Short Equity Fund will join in for some fundamental stock analysis. A little later, we'll talk about that investor meet. Vimal Kejriwal of KEC International will join in to talk about the meet and, of course, some of the new order wins since the last time we spoke with him. Back in 2.
Welcome back. Well, the SGX Nifty is now inching ahead. It's up almost 45 odd points, so get ready for a good opening today. KEC International has won new orders worth around 1,100 crores. This is across its transmission and distribution, railways and the oil and gas pipeline segment. To discuss the execution timeline and how the business is shaping up, we are joined by Vimal Kejriwal, the Managing Director and Chief Executive Officer at KEC International. Mr. Kejriwal, good morning. You are winning new orders, but the margins continue to remain under pressure, perhaps because of the execution of legacy orders and continued losses that you're seeing in some of your verticals like Brazil. Wanted to understand from you, are any of these losses subsiding, and will the margins continue to be under pressure in the quarters to come?
Good morning, Sonia, and thanks for having me. So, Sonia, we have had a margin concerns on two accounts, two headwinds. Basically, one was Brazil, and second was the raw material prices, especially steel and aluminum. As far as Brazil is concerned, all our legacy projects will get over by October or max, let's say 15 November or so. So Q2 and maximum Q3 would be the last quarter where we would see a negative impact from Brazil coming in. So Q4 onwards, I think we have a good book in Brazil on supplies. So it will start turning positive from that. As far as metals are concerned, so most of our legacy orders are now under execution, and to me, most of them will again get executed by Q2 or maybe Q3 also. But the difference between Brazil and metals is that, we have announced almost 6,000 crores of orders, and all of them are at current prices or maybe even higher than the current prices. So once the execution of these projects takes off well, they have already started, but it will take some time. So the positivity from these numbers will also start coming in, and which should sort of neutralize the negativity from the earlier orders. So
just to follow up there, you said that all your legacy projects in Brazil will get over by October, and Q4 onwards things will improve. So what does this mean for your margins? You're still sitting at about single digit to 5% margins or so. How much could it improve to by the end of the year?
So what we have been talking about is that Q2 would remain at a similar level to Q1. Q3 we will start improving, maybe 50, 60 basis points, 70 basis points. It will to depend more on how much we are able to fast track execution of the newer projects other than Brazil. Q4, maybe another 100 basis points. And what we have been generally talking about is from FY24, we should inch back towards our normal double-digit margins.
Mr. Kejriwal, hi, good morning. That investor conference as well, where you addressed analysts, etc. This FY25 order book, is that a new number, 40,000 crores?
Yeah, Prashant, it's a new number which we had not discussed earlier. There was general discussion saying, where do you look at your order book going in a few years? And we expect, today my order book is roughly around 24,000 and odd crores plus another 8,000 crores of L1s. Okay. So we do expect that this year we should have an order intake of 19 to 20,000. So we were just saying that if we are growing by 15-20%, and the way we look at order intake is that it should be at least 1.2 times of the revenue forecast, etc. So we just added the numbers together and said, to have a decent growth of 15-20%, we should have an order book by 2 years ending at 40,000 or something.
I mean, the one segment which has been kind of doing very well is the railways as a segment, right? Is that, how is the momentum looking there? Are things picking up? Could you give us some more idea? Out of this 40,000 crores, what is the railways contribution going to be?
So just to address your first question, I think railways had been a bit slow in the last 2 years. Our order intake has been virtually flat. But this year, railway has surprised us. To be very honest, we had not expected that we will get so many orders. Even this order release has 40% from the railways. So, and it's happening both on the conventional side as well as on the metro side. On the conventional side, the Mission Raftar is doing very well, where we're getting a lot of orders for, speed upgradation on the metro routes from 110 to 160 kilometers. And secondly, in yesterday's order, we announced the first order on the train collision avoidance system, TCAS, which our ministry has been talking about it. So in JV, we got our first order. So, on the conventional side, we are seeing a lot of traction. Also, we have seen announcements of new lines, doubling and tripling, which had been sort of missing for some time. In fact, in our L1 order book, we have got a couple of orders which are on doubling and TAS. Then coming to metros, although we have not seen too many new announcements, except the last one where the cabinet has cleared the Kochi metro. But, a lot of civil work has been happening on the metro. So now the electrification and other parts are happening. And we have been seeing a fair amount of success in that.
Okay, one perennial concern that investors have had is the high debt of the company, and that has gone up in FY22 as well. I know you did address these concerns at the analyst meet, but just for the benefit of our viewers, how much do you plan to bring down your debt by, if at all? What does it stand at right now, and what's the targeted debt, say, in the next 1 to 2 years?
So, Sonia, our overall debt, if I include acceptances, bill discounting, and everything, is around 6,000 crores. And we have been talking about bringing it down to roughly around, say, 5,000 and odd crores by this March end. In terms of working capital, I'll say we are today at around 150 days, and we have said that we are trying to bring it down to 130 days by this March end.
Sorry, bring it down to?
130 days.
130, yeah, no, absolutely, you have. And that's a bit of an improvement as compared to what you said at the end of the first quarter. So maybe things are improving at a faster pace.
Yes.
There is more visibility. So just on the other segment, the T&D side, is tendering. Last time you were on, you said that you expect tendering to kind of pick up as well from Power Grid. Is that happening at all, or is there indication of that happening?
So, Prashant, in the last 3 order releases which you have had, each one of them has 1 order from Power Grid. Okay. And also we are L1 in orders from Power Grid. So clearly we are seeing Power Grid suddenly ramping up. And once the Leh Ladakh solar project comes up, where many of the projects have apparently been allocated to Power Grid, then that could be one piece. And the second piece, if you remember, we talked about the GIB case in Supreme Court.
Yes.
That has held back a lot of tendering in the Rajasthan solar area. Once that gets resolved, you will see a large amount of tenders being decided on the TBCB route, and Power Grid will get a fair share of it.
Okay. I just had one follow-up. You said that your current debt is 6,000 crores, and by the end of FY23, it will go to 5,000 crores, correct?
Yes.
But in the earlier interviews, you had also indicated that your eventual target is to bring down your debt to 2,500 crores. By when and how do you plan to do that?
No. I think there's a slight difference. That is actually the bank debt, which is around at 3,500 crores right now.
Okay.
When we say 6,000, what we are doing, Sonia, is we are including all the bill discounting and other acceptances, etc., which are technically not a bank debt, but analysts always consider them in debt because it has an interest cost.
Mr. Kejriwal, on that GIB issue, what is the timeline there? The courts have to take a stand, right? Take a view.
So as far as I know, Supreme Court has appointed a technical committee to look into it, to decide, at what voltage level, cables can be feasible, what levels you require. So our understanding is that the ministry has been saying that up to 220 kV we will go underground, and beyond 220 kV there is no choice. The costs are prohibitive, or it's not technically feasible. Some things like that are going on. So Supreme Court has appointed a technical committee to look into all of this. Decisions were expected very quickly. Let's see how, because it is holding back a lot of solar projects and a lot of transmission projects.
No, so what next? I mean, will there be a definitive go-ahead from the ministry, or what should we expect in terms of next moves?
So the definitive go-ahead will come from the Supreme Court decision on this issue.
Okay.
Yeah.
Once the technical the committee submits its report, and then the court will have to. Okay, got that. Mr. Kejriwal, thank you very much. Great speaking with you, sir. Appreciate you joining me on the program.
Thank you.
Thanks indeed. Anuj.
Okay, we have Rajesh Bhatia now joining us. He's the Managing Director of ITI Long Short Fund. He's Chief Investment Officer as well there. Rajesh, hi, good morning. Thanks a lot for joining us. Very strong outperformance for Indian market, Rajesh. What's your view? What's driving it? Yesterday, for example, the market saw that massive recovery led by the Bank Nifty. Your views?
So India is really seeming to be a great house in a really bad neighborhood. I think if you look at across the world, there is concerns of a sharp slowdown, whether it is China, Europe, or even the United States. And given the inflation number that the US kind of saw, I think there is concern that you would need to probably trigger a recession to bring that inflation down. Given all of the context that is happening in the globe, when you look at India, I think when we speak to companies at a bottom-up level, there is extreme bullishness. Maybe it's the post-COVID reopening confidence that is there, which is buoying up demand. Definitely at the premium end, there is strong demand. Maybe, it is a factor of India's momentum being strong, given the context of various measures that the government took over the last few years. The fact that, our profits to GDP, while it has bumped up in a year or two, has been at a 15-year low. The cleaning up of corporate balance sheets, bank balance sheets, all of them probably is coming to fruition. But there is definitely a lot of optimism as far as India is concerned. So it is a case of a good house in a bad neighborhood. And of course, that's why India is getting a lot of attention.
Okay, good house in a bad neighborhood, right? I mean, I like that. Wanted to talk about some themes, Rajesh. Premiumization is a big theme across the board that we're seeing, right? Especially in FMCG, in autos. Is this a theme that you'd like to play? And if yes, any specific stocks that you're looking at here?
Oh, certainly. I think premiumization is probably a structural theme. And in fact, if you can find a stock which is a pure play on premiumization, I think the growth rates will be relatively more attractive to the category that you're playing in. So definitely, I think these type of stocks would make a good portfolio over the next 5 or 10 years. I think India is witnessing what we would call a K-shaped recovery. There is surprisingly extremely strong demand at the higher end. Whether you talk to, this is across sectors, whether you talk to real estate companies, garment companies, automobile companies, all across. I can't think of any segment that is not telling us that the premium end is growing at a faster rate. Having said that, at the same time, the lower end is struggling. And therefore, this K-shaped recovery is really, that is happening and that we are witnessing today. I think you could find any, whether it is automobile, if you can find a pure play, premiumization play, I won't take names, but I think it's obvious which are the premiumization pure play in the automobile sector, or let's say, I would say even in the jewelry sector, or let's say the garment sector. All of these names are obvious, but each of these probably seem like secular growth stories to play over the next 3 to 5 years. I don't think the valuations are that compelling at this moment, but that's also the case for the market. I think the market is also priced at 19 or 20 times financial year 24, but I think this theme certainly has multi-year legs.
Premiumization across sectors, absolutely. We've heard from more than one corporate that this is exactly what is going on. Rajesh, let's talk about what you don't like. That's always an interesting conversation. One of the areas we've spoken about in the past as well, and I think you've put on positions there, is diagnostic companies. We've had a bunch of recent, I think Credit Suisse came out with a report, initiated coverage, much lower levels, etc. Any views there on diagnostic companies, and what else in the not like list?
So I won't confirm to you whether we are still short this sector, but definitely I think if you look at the diagnostic profitability, 18 or 20% PAT margins, that is probably one of the highest margins that you would see in the corporate sector in India, and the ease of entry into this business. My sense is that whether it is digital players which are accelerating growth in this segment, or even credible players, let's say like Tata 1mg, they are definitely not allowing these players to increase prices, if ever reduce prices. Definitely those realizations are not moving up. In fact, they have not been moving up for more than 5 or 6 years. And I am told that the industry has now started to offer discounts. I'm talking about the incumbent players. And therefore, there is some pressure on realizations. At the same time, I think the cost structures of these companies will have to go up as they spend more on sales and marketing and other initiatives. So my sense is that as you move forward, this sector is certainly something that could see pressures, at least in the short term, 2 or 3 years. And therefore, I think it is certainly an area which could be under pressure. Among the other things, look, in every market, as much as stocks go up, there are sectors that are going to, come down, or stocks that are going to come down. I think, let us say, I can point out to pockets of weaknesses. The oil marketing companies certainly comes to mind, given the government's reluctance to increase petrol and diesel prices, given inflationary concerns, has meant that marketing margins for these OMC companies has been in a severe deficit. Some people estimate the annual deficit of this, which is losses for petrol, diesel, LPG, could be as high as 2 to 2.5 lakh crores, or at least 1.5 to 2 lakh crores. That's a huge deficit that has to be kind of borne. And given government finances, also it is unclear to the market as to how these companies will be compensated. So again, that's an area of weakness. And like we pointed out, a K-shaped recovery doesn't necessarily mean very good things for companies which are catering to the lower end of these segments. Yeah.
All right, Rajesh, we got it. Thanks a lot for joining us. Have a good day. We need to take a break. Once we come back, we'll shift focus on the market technicals. Sudarshan Sukhani and Mitesh Thakkar will be joining us. Welcome back. Let's look at what the global cues are indicating. Not that it matters a lot in our market. It's just been such a strong market, especially on the financials and the domestic stocks. 18,042 on the SGX Nifty futures. Mitesh Thakkar and Sudarshan Sukhani joining us. Gentlemen, good morning. Sudarshan, yesterday the market saw massive sort of bounce back, especially on the bank Nifty after that big gap down. But you tell us, this morning, if the market opens 40, 50 points higher on the Nifty, what would be your trade?
Yeah, good morning, Anuj. See, I think we have all understood that yesterday and earlier also, every significant low is being bought into. And the market and the Nifty keeps on making a pattern of higher lows. So this market is not willing to go down so far. The chances are that for the next few weeks, we may probably see a test and an attempt to break the lifetime high of 18,600. It's a bull market. Therefore, in a bull market, the ideal trade is always to either step aside or go long on some intraday dip or intraday consolidation. I think today is another day when we would like to go long. If a 40 or 50 point gap up is given, and the market stabilize in the first 15-20 minutes, then buy the Nifty. Now, the same applies to buying the Bank Nifty, but because Bank Nifty had a big rally yesterday, over and above the bounce back, perhaps the Nifty may be a better choice today, but stay long in this market and buy it today.
Okay, stay long. Mitesh, good morning. What's your approach on Nifty and more importantly on Bank Nifty, where we had that 1,500 point intraday rally?
I think yesterday also I was trying to highlight the same point that the Bank Nifty is possibly something which will lead the Nifty higher. It was an all-time high beyond that level of 40,300. We had the discussion a few days back. And, I think now we are looking at targets of around 42,250 to begin with. But I think eventually the medium-term targets are closer to about 44,000. So very positive on that. I think declines in Bank Nifty should be used to buy into it. Of course, you can use the Nifty as well. But I think between the two in the short term, the Bank Nifty might again gain momentum and slightly outperform. Having said that, on the Nifty, I think the next target would be around 18,150, 165. If that is clear, then we will look at a test of 18,350.
Okay, well, let's do one thing. We'll take a break and we'll come back and address the stock calls from both Mitesh and Sudarshan.